Just when we had a little breather and we saw green days for the past week or so, the fear is back in the market. Stocks are dropping, especially growth stocks. So here today we're going to talk about what happened, why is the fear coming back, why are stocks falling, and what should you be doing as an investor, if anything, right? So we need to talk through what exactly happened and then see what's falling and what causes the fall. So here today we have the US inflation data that came out, which is now surprised to the upside, unfortunately, which is now the highest in 40 years with no let up in sight. Inflation soared over the past year at its highest rate in 4 decades, hammering American consumers, wiping out pay raises, and reinforcing the Federal Reserve's decision to begin raising borrowing rates across the economy. So we came in at a over 7.5% interest rate for last month compared to a year earlier, which is the highest since February 1982. So alarming inflation rates, and we do really, that's what's driving the fear in the market right now. We do want to see it coming down, but the question is, what is the solution? How is it gonna come down? The Federal Reserve, for now has not reacted, has not raised interest rate, but has announced to do so later on. So investors are basically looking into that, saying, okay, based on that, because it's even higher, probably they have to raise rates even higher to get that down more. So this is what's saying here in the beginning as well. The Federal Reserve decision to begin raising borrowing rates across the economy. So what have we seen in the market based on that news? So we actually seen quite a good start to the day where everything was kind of green. We had massive earnings that I made a video, I will link it up here. I made a video on Twilio yesterday. They've smashed earnings. They were up 19% pre-market. And then we'll go back down to Twilio here now, right now, only up 1%, 1.4%. And we've seen that, the drop down here, everything basically dropped after inflation rates were announced. And we do have some huge losers for today. Affirm, Overstock, AMD, CRISPR, Adobe, all down massively. Affirm leading the pack here, down 22% on those news for the interest rate. So that's just insane. I mean, for one day a 22% move. I mean, we do see a really aggressive reaction in the market whenever they talk about inflation or interest rates. So the question is, why is that happening, right? So we got to talk about what causes this drop and what caused the drop, especially in growth stocks, right? So, and the answer to the question is pretty much this here. So the DCF model, the discounted cash flow model, which is usually like a key resource for people or investors when they want to assess the company's so-called intrinsic value. So what is the company worth at compared to whatever the price reflects today at the current market level. And what you got here, so we don't want to get too much into the details. I just wanted to show you the basics, right? Just to explain to you, why do higher interest rates matter for sort of the valuation perspective, and especially hitting growth stocks very hard. So what you have here is a discounted cash flow model. The way it works is you would enter your estimated cash flows for the next 5 years in here, in this row, which is based on estimates, growth estimates, analyst reviews, and so on, and your own research, basically saying, well, if you have $1 million now, I'm assuming a 25% growth rate next year due to reasons 1, 2, 3. So this is how you would do it, and then basically you get your cash flows for the next 5 years, and then in theory what you would do is you would just add them up, and this is the total value of the business, right? But the way this works here is you have to think that, well, my cash flow that I will get in year 2, 3, 4, and 5, they are less worth today, because obviously if I had the money today, if you give me 5 million today, I can make investments and generate compounding returns within that 5 years, so that I would actually not need as much money in the future. So for instance, in year number 5, if you get 1,900, that's the same as if you give me 1,500, for instance, today, because I, in the meantime, can in 5 years generate a risk-free return that will equal that 1,900 just by compounding it using something else. Because you're basically deciding, right? You're deciding, this is my money right now. I have $1,000. Do I put this in investment option number 1 or number 2? So if you put it into investment option number 1, like a company, you would do this cash flow model to see, based on the growth projections, will my cash grow at a higher rate than investment option number B, which might be savings account or might be some fund or something else, or house. So that's that, right? So you would say, okay, yep, based on those growth rates, I'm happy with that. But what happens now is, the higher those, so we have a rate here which is called the discount rate, which you can actually put it equal as the rate of, the same as the interest rate, basically. So and the way this model works is, the higher that rate is, the lower the present value, and also the later the cash flow that you get. So for instance, a cash flow you get of 1,900 in year number 5, discounted at 25%, is only 600, whilst a cash flow of only 1,000 discounted in year 1 is only, after year 1, is only 800. So it's probably it's much more than the 600, although you've earned almost double, right? Like you see, 1,000 compared to 1,900, but discounting that over 5 years gives you only 600 as present value, versus for only 1 year you get 800. So it's pretty much saying, if you give me 800 right now at 25%, in 1 year you get 1,000. If I give you 800 now, if you give you 620 now and it compounds at 25%, you will have 1,900 in year 5. So this is why discount rate, interest rate matters, because the higher this number, the more, the less your present value, the less your share price, because your present value is just the overall amount of value of the company. So you just divide it by the number of shares that are out there to get the per share price. So the lower the number of the present value, because of the higher interest rates or discount rates, the lower the share price. So that's why we see stocks dropping. And why do we see growth stocks especially dropping? Well, that's because growth stocks usually don't have a profit, or don't make little, or only making little profits in the beginning. But as the name suggests, they're growth stocks, so they are expected to grow at a rapid rate, much more than 25% sometimes, for in year 3, 4, 5. So that the majority of the cash flow will be generated in year number 4 and 5. So that, for instance, in year number 5, if they've actually doubled their cash flow, but we have a high interest rate, it's actually less worth than a company that only makes 1,000, but they make the 1,000 right now, because that will give you 800 versus my company makes double than yours, but only in 5 years time, because now it's not there yet. That means that money, that 1,900, that double up from the 1,000, is only worth 600. So yeah, I hope that wasn't too confusing, but I basically wanted to tell you that for a uncertain high growth company such as a Twilio, that they don't make much profit at the moment, or even running at a loss, because we expect so much cash flow in future years, in year 3, 4, 5 and so forth, that gets more heavily discounted at an expected higher interest rate now that we have these high inflation numbers, than something like a Coca-Cola, who has, who doesn't need to grow anymore, because right now in year 0 and year 1 they already have 50 million of income. So that income is already going to you as a shareholder in year 1. Discount rate almost has no effect on it, just a little bit. So yeah, this is why we do see all those growth stocks getting hammered today. So I hope that you as an investor can look beyond that, because what you want to do is, obviously, it does affect the valuation. So you want to see that if you invest right now into something that the multiples are right, you can't really know which interest rate you're gonna put there. And also I've done another video where we've seen that actually interest rates will make no difference to it, and rising interest rate might even mean that the market will outperform over time. We've seen that over and over again over the history. So you shouldn't focus on too much about what exactly is the interest number, but you should be looking at, well, what is the company doing? What is the growth rates? Is it sustainable? Will they take the market share? Because guess what? If it's a good company, good management, and they're growing at a rapid rate, and they consistently growing in line with management's expectation, that means that over time they could basically survive in any type of environment. So the only thing you might want to look out for is you don't want to be over leveraged. So on the balance sheet, for instance, if you look at something like an Affirm, you want to go into the financials and you actually want to see that in the balance sheet you don't have much debt there, right? Because long-term debt, such as Affirm has, where they have $2 billion, that basically means that, and cash just barely covers it. That basically means that, that in higher interest rate for them might be challenging as a business, as it squeezes the profits and makes business harder. But for a purely growth play that has almost no debt, such as in HIMS, for instance, they're just growing rapidly, have high margins. They're just running at a loss because they spend everything on marketing. So they actually don't really. The only way that interest rate affects them is because of that discounted cash flow model that we just seen. But in terms of a growth rate and business perspective, they will not get really affected by it. So they can just execute in any case. And you've seen companies like Apple, Google, Microsoft. They've been through, all sorts of different situations, and it didn't really matter in the end if it was high interest, low interest, if it was the recession, not recession, global financial crisis, and all that kind of stuff. Of course, the stock price does like this, but the actual company was like this, right? So that's what you have to separate on. This is macro, which, just for the time being will reduce stocks, but on this side you have the company, where you have to analyze and see, is it a good company? If they're good enough, they're gonna make it work, no matter what the situation is. So just be careful about high debt companies, and companies that might slow growth, and basically, where the cash flow model actually makes more of an impact on those. So yeah. Quick update for you today, guys. I hope you like that. Let me know in the comments below if you're worried about the inflation at all, or if you just have that long-term mindset that you actually look beyond that and you don't really care and you invest anyways and you just buy the dip basically. Leave me a like and subscribe if you found that content helpful, and see you next time.